Good afternoon and welcome to PhillipCapital UK's webinar. I'm Andrew Hall and I'll be introducing you to Forex Trading, the basics. The webinar will hopefully enable you to build a strong foundation in Forex trading on which you can build upon to become a successful trader with us here at PhillipCapital UK. Before I get started, let me tell you a little bit about who we are. PhillipCapital was established in 1975 and it has its headquarters in Singapore. The PhillipCapital Group has grown into a global financial powerhouse with presence in 16 countries and over 1 million clients now worldwide. PhillipCapital UK, however, brings this heritage and expertise of the group over here in London. We're looking to build long-term relationships with our clients and partners. We offer online trading in spot Forex, index CFDs, spot metal, commodities, including both Brent and WTI. Our clients have access to top tier and deep liquidity from both major banks and non-bank providers. We are regulated by the UK's FCA, so clients can trade with confidence and at ease, whilst receiving support from our experienced and multilingual account managers. Also, while I've got you here, if you haven't done so already, I would advise opening a demo account. It's very simple to do, and it's a direct representation of our live accounts. In your demo, you will have access to 50,000 worth of virtual funds, so why not test some of the trading theories learned today, and let us know how you get on. So let me give you a brief introduction of what we're going to be doing today. In fact, before that, I'm going to give you some news about our sort of current promotions and what we've got going on. So we've got the fantastic news that we will be offering our clients the opportunity to trade equities. This will include the top US stocks from the Dow Jones, NASDAQ, and S&P 500. I'm also excited to share with you that we'll soon have a new and improved website and customer portal. There will be further announcements on this in due course, so please keep your eyes peeled for more information. Also, I know this is brief, but if you do have more questions on that, then please do get in touch with our support team on 0207 3983 100 or support at phillipcapitaluk.com. So yes, back to the introduction. Pretty self-explanatory. We're going to be going through MC4, showing you how to open a trade, use the graphs, and sort of the basic features on MC4. We'll then be going on to trading psychology, risk and money management, and both technical and fundamental analysis. However, before I get started, I do need to go for a quick disclaimer, so bear with me as it's quite lengthy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 54% of retail investor accounts lose money when trading CFDs with PhillipCapital UK. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. The following webinar is for educational purposes only and does not take into account your objectives and or your financial situation. The examples we use are not recommendations or solicitations to trade, nor should they be taken as advice. More information about our terms and conditions can be found on our website, of which there's a link on your screens in front of you. So, as we're going to be talking about the Forex market, I'm going to give you a brief sort of background and a bit of knowledge on that. So, the chances are you most likely already have some interest in the Forex market. Hopefully today we'll build on that interest so that you can develop your FX skills and acumen and become better traders. Ultimately, that is the main goal of all traders, all retail traders. You want to be successful. Also, if you've travelled sort of internationally, you probably already have Forex trading experience when you've bought the currency of your destination country using your own national currency. But hopefully within this, we'll go through what Forex offers you, what the market offers you. So firstly, accessibility. Advances in technology have increased accessibility of Forex trading for the retail client. Clients can now are now able to trade on their phone, tablet or PC, with their volume forming part of the $5.3 trillion that are traded every single day in the Forex market. Also, it's a 24-hour market, so it is exactly that. So you can trade, whenever you feel the need to, especially with your phone. If you're out and about and you've got good signal and you've seen an opportunity to trade, why not go for it? So again, you don't need to wait. So it's perfect. Also, we have it's a narrow focus in comparison to other financial instruments. So if you consider stocks, for example, equities, which we will be offering, there's tens of thousands of equities to choose from. Whereas within FX, it revolves around 8 FX majors, which include the US dollar, euro, and the British pound, as well as other currencies like the Japanese yen. This narrow choice allows the traders to focus. So even though the market is huge, you can focus on the FX pair you are looking to trade. You don't need to look elsewhere. You don't need to understand everything about a company. You can just focus on the US dollar, for instance, against the euro. Also, liquidity. So the sheer volume of daily FX trades makes the market the most liquid in the world. What does that mean for you? Well, put simply, it means that under normal market conditions, you can buy and sell currency as you please. This also helps minimize slippage, so that the price you wish to buy at or sell at is the price that is filled in the market. So basically, there's always someone there who will buy, and there's always someone who will sell, again, during normal trading hours. The market size. The colossal market size means that even large banks struggle to have the pull to really control the market, which is great for the individual trader, because again, you've got a fair crack at the whip. You can go out there, you can trade. Also, lastly but not leastly, the bottom of their profitability. I mean, this is ultimately why people sort of wish to trade. They want to be successful. So the FX market gives you the opportunity to be a successful trader, and with that, become profitable. Generally speaking, this will mean starting with an account. Our Phillip account starts from as little as £200, dollars or euros, and it offers you your window of opportunity to start your trading adventure. Hopefully, it must be said that trading, it does involve risk. So you do have to consider that as well, especially for leverage products. So please do take this into account, and only risk money that you can afford to lose. The FX market is always on the move, and there's never a quiet day. So there will always be an opportunity with tiny shifts in currency rates. So MT4. So in this section, I'm going to take you through the basics of MT4, one of the most popular trading platforms worldwide, due to its functionality, ease of use, and adaptability. So plugins can easily be added to suit your trading styles and needs. Also, I'll take you through the basic functionality. So we'll firstly be looking at how to open a trade, add a take profit, stop loss, or trailing stop. Again, I'll hopefully explain these so you can get a better understanding of what these are. And then I'll move on to sort of graphs and indicators. We'll also end looking at MT4 detailed reports. These are very useful, and I think a lot of our clients don't always utilize this tool within MT4 because it gives you some very good statistics about how you trade, and can give you opportunities to understand how you can improve and perhaps where you're going wrong. So again, it's like I said, I'm going to take you to MT4 now. to go through that. So bear with me just while I load that up. Also, throughout this webinar, if you do have any questions, please do reach out to us. I mean, if we are unable to get back to you now, we will get back to you as soon as we can. So yeah, any questions, whether it be basic or more complicated, then like I said, please reach out to us, because we are more than happy to be of help. So placing a trade on MT4 is fairly straightforward. First of all, you make sure you're on the right chart, as this will determine the order box that will pop up with all the relevant information. So let's select cable for you guys. Right. So if we take sterling dollar, which is also known as cable, if you select the order tab up here in the tools section, so just up on here there, you can then select new order. So I'll just show you what comes up with that. This will then load up the order box. So again, this will not only come up with the symbol that you wish to trade, but also the sort of correct mapping. So again, you can see that's you know, whether that's spot, hash, or top hat. So again, it's you know, look out for that as well. So within that, you can see the order box. It gives you both the volume, also the stop loss, and take profit section. You can also see the type. So again, you don't have to do market execution. You can do pending orders. Again, we're going to go through market execution as it's sort of the basics. We're not going to be going through all MT4 functionality. Again, it's you know, there's many things you can do on MT4, but again, hopefully we can cover all the basics for you. So in order to do this, if we wanted to open a trade, we would firstly choose the volume at which we wanted to trade at. So let's say we trade a micro lots, which would be 0.01. Again, it's important to understand the volume sizes. So within Forex, one lot would equal 100,000 units, whereas a mini lot would equal 10,000 and a micro lot 1,000. Please bear in mind, like, the margin requirements needed to open the position. We'll be going through sort of some trading strategies later on, and that will give you a bit better understanding to how to best use your account balance and not sort of load your equity and balance on perhaps one trade. Again, it's you know, a riskier strategy. Again, margin call would be set at 100%, in which you would get sort of an email from us guys to advise you to top up that. And stop out is at 50%, in which your largest loss making position would be closed. So within the box there, you can see you've got the stop loss and the take profit. So if we just come off this for a second, you can add in your stop loss there. So if I'm going to buy, let's take that down to one spot 4585, and I can do my take profit. Let's go at one spot 14635. Perfect. As you can see, that's now executed that for us, and you can see on there the stop loss and the take profit are there at the bottom of your screen. Also, what's good about MT4, it will also add the take profit and stop loss onto the graph itself. So again, in this case, because we had the graph up, the order book done it for euro dollar. If you wanted to do that for cable, you could right click, new order, and that would bring up the cable chart for you. So again, we could then trade like that for cable and do exactly the same thing, and sort of go from there. I'm just going to close this out there, and let me just close. Bear with me just 1 second. I'm just going to close this. Perfect. So now I'm going to show you how to add a trailing stop. So again, if I was to just open a trade, I don't want to do a take profit or anything. I will go new order, and I'm going to buy at 1.298. Perfect. That is then on my trade tab down the bottom there, as you can see, and I've got filled at 1.29801. As you can see, there is no stop loss or take profit on there at the moment, and I'm currently losing minus 0.1. So again, at the minute, hopefully it will sort of turn around for me, but at the moment it hasn't just yet. So if you wanted to add a trading stop, you would right click within the trade itself, select trailing stop, and then you can either select the options that are there. So you've got 20 points. 20 points is the minimum at which you can add a take profit, stop loss, or trailing stop within MT4. So again, you can customize that. So 20 points would be 2 pips, or you could do 100 points and have 10 pips away. Again, it all just varies on your strategy and what you're looking to achieve. If you're sort of an intraday trader, you might go a little bit closer, whereas if you're perhaps looking more long term, you may go further away. Again, it comes down to you as the individual and what you would like to do. So if we do custom, and let's do 70 points away on that. So if I select OK, that will now be added to that trade. It's not active at the minute because what I need to happen is for the trade to move 7 pips in the correct direction. So I'm looking for sterling to raise in value against the dollar. At the minute, that hasn't happened. What I will do, I'm just going to put the graph up there for you guys so you can see that. There you go. So that makes a little bit more sense for you guys as opposed to looking at euro dollar there. So yeah, you can see the trade there. The trading stop is on, but it's not activated at the minute. So basically, with the trading stop, if the currency pair was to move for you, the trading stop would move accordingly, sort of remaining 7 pips away. Alternatively, if the position started to move against you, you would secure your position 7 pips away. Again, like I said, you need to secure those 7 pips in order for the trading stop to then take effect. But people use it because then it will then follow the currency up with you. So the trading stop would move. It's not static. Again, it's a good tool if you're looking perhaps longer term and you're monitoring as well, because obviously bear in mind there won't be a stop loss if you don't secure the 7 pips or whatever you decide, whether it be 2 pips or anything from there on up. But do bear in mind that if there was a market jump and which there was no price actual trading stop, then this can happen with sort of shock market movements. You won't necessarily get hit at your stop loss. You might then get hit at the next available price. So then obviously not guaranteeing you the 7 pips. This is rare, but again it happens during times of sort of high market volatility. On the tools window, let me just show you. No, view window, I'm afraid. You can also change the view of your MT4. So what I'm looking for here is the navigator section. The navigator section allows you to add into your graph indicators. So again, this is sort of, I'm going to show you a couple of indicators here. Again, indicators are very vast and they are in depth. So it's one of those ones that I think if you do find this interesting, then look into it further, and if you do have any questions, then like I said, do reach out to us, as we'd be more than happy to be of help. So if I open up the indicator list here, it will categorize them into the type of, whether it's a trend, an oscillator, whether you're looking at volume. So again, what I'll do, let's have a look what's under volume. So let's also go under trend, and let's have a look what we've got here for you guys. So what I'm going to do, if you want to add in, for instance, the moving average trend line, you can left click that to select it and then move it across onto your chart. So in this case, cable. It will then give you a pop-up window. In this, you will then select your parameters. Again, you can do levels and visualization. MT4 will always have default data within this. So again, it comes down to whether you want to change it at all. But for in this case, I'm going to leave it as it is. Also, you can select the color. So in this case, I'll go for a yellow. And OK. And perfect. And then what that's done is then that's plotted that on to the MT4 graph there. Again, you can also see where it places the line of where I bought at as well. So you'll always see that when you enter a trade. I'm just going to have a look at some of the other indicators that I can show you. So bear with me. So what I'm going to do, I'm going to add the RSI on as well. Perfect. So now that's added on as well. So that's brought that down the bottom there. You can also, if you feel that's taken up too much of your screen, you can then lower that down, and that can sort of make it a little bit more visible for you guys. So basically, with the RSI, this will measure the relative. It's called relative strength, and basically it will show you whether something is being oversold or overbought. So again, this is done on. You can amend the levels, but again, it's sort of at 70, it's considered to be sort of overbought, and is then expected to come down again. You can see this perhaps on the 16th of October, and it gradually come back down again, and then towards the end of the 16th into the 17th, we've gone down to sort of being oversold, and it's sort of gone back up again. Again, some people like to go a little bit above these levels. The 70 and the 30, it comes down to the individual and your preference and strategy. So what you can do, as you can see, I've got two windows up. I've got the euro dollar across here, and I've also got cable over here. But in order to view both at the same time, I'm having to switch across. If you don't want to do that, what you can do is use the toolbar at the top and select this Arrange Windows as Non-Overlapping Tiles. And then what that will do, it will pull them up together, and you can then see both at the same time. This comes in very handy if you've got correlation between the two Forex instruments. This could be like sort of in this case where you've got the dollar in both, or there could be perhaps economic data for both coming out on the same day or even at the same time. You may have summits going on, or government speeches. Again, so it all comes down to you as the individual and finding out what works best for your trading strategy and your goals. Before I leave you on MT4, again, there's a lot more you can do on MT4, and I do understand perhaps there's quite a few of you guys that do already know this, and that's absolutely fine. But there is also people that perhaps don't. So, like I said, hopefully that's been of help. Just to show you the MT4 detailed reports, so you'd go on to your account history tab. This is down the bottom here, and then on this will give you your trades. So what you'd want to do is select one of the trades. Then if you right click and select all history, again you can have your own parameters here. So if you want to do a custom period, you can. If you want to just do the last month, you can. It all comes down to you. So I'm going to go all history. This should then bring up the whole history of that account. You can then go right click again and save this as a detailed report. Again, very useful to do this. You will get reports sent to you from MT4, and I do advise that you look into these. But like I said, it is good practice to perhaps when you finish your trading session for the day, or you think, oh, you know, I'm gonna head off now, look at your detailed reports and try to look at some of the trades that have gone well for you and some of the trades that perhaps haven't, and try to understand perhaps where you're going wrong and things that you can do a bit better. So if I select save at detailed report, bear with me, and let me just find that if you bear with me just 1 second. Right, perfect. Hopefully this works. Yes, brilliant. So again, what it will do, it will open in a HTML file. This will open in a browser. In that case, it has asked me what browser that I would like to open it up within. Perhaps in your own browser, it might go straight away to your default, whether that be Internet Explorer or Chrome. So again, this will show you your a detailed history of your account. So again, you've got all your trades at the top. Closed transactions, you have your open trades, and you'd also have pending orders. So it's good to see those as well, illustrated for you within one table. You can then go down, and this account hasn't got a lot of history. So again, the more history it has, the better, the better it is, because it works off data naturally. But what it will do, it gives you a nice clear picture of what you like doing, where you've seen success, and perhaps where you haven't seen success. So, what I find particularly interesting in these, a lot of people are interested in like the largest profit trade, but the average is very good. Ultimately, if you're looking to be successful long term, it's going to be the average that you want to improve. I mean, you will get people that will focus on the largest profit and those sort of things, but again, it is about what works for you. And largest profit, if it's offset by largest loss, it doesn't mean too much. I do also like the percentage won tables on there as well. So you've got short positions won, and you've got long positions won. These are very sort of interesting statistics that you can look at. Also, the graph above this also details your balance and shows you the deviation of your balance. So again, this can be down to you depositing more funds or withdrawing funds, but again, it will show you sort of it will show you sort of how well you're doing on your account. So again, I would advise that you look into this. Like I said, it is interesting, and it will help you improve. Right, that sort of brings an end to the MT4 section. So I'm just going to come off this and get you back onto the slide. So just bear with me just 1 second while I do this. Perfect. So that should be that done. Let me just get to the next one. So we will now look into trading psychology. I'll start with random reinforcement and revenge trading. Both significantly add to the psychological strain of trading in the Forex markets, with traders making quick, emotive decisions in order to make fast gains and alleviate losses as a form of revenge on the market. What you've got to remember, though, is the market does not care about you. It's not emotional. Try to remember your long-term goals. Are they realistic? Are you looking for short-term immediate gains? Also, what's viable in the current market conditions? You have to always consider, okay, that's my goal, but is it achievable? Is it realistic? These are the questions you must continually ask yourself. Try to better understand the market. Why did the market move? Could you preempt a swing and utilize pending orders? Again, it's not about just executing straight into the market. Look at pending orders. rather than saying, okay, I'm going to trade now because that's where the price is at, maybe wait for the market to move. If it doesn't move your way, the order's still there. You can wait for when it does. Again, you can add in your stop losses, you can add in your take profits, and that will help you. That will help you. Also, do consider trading smaller sizes or reverting back to the demo. Even, test your trading strategy. Ensuring you to attain a degree of success before risking your own capital. Again, it seems sort of common sense perhaps for some of these things, but you would be surprised by the amount of people that don't follow these simple rules, and it can get out of hand quickly. Gambler's fallacy. So this is the misunderstanding of probabilities. So it's a mistaken belief that because something has happened more frequently than normal during a set period of time, it will happen less frequently in the future, or vice versa. Always remember to assess each trade on its own merits. Remember, there is no such thing as a winning streak. Euphoria will blur your judgment. Conversely, a losing streak will also cloud your judgment. Note your trades, research the market, educate yourself, and always check your MT4 reports. Like I showed you a second ago. It's going to give you a better understanding of you and how you can enhance your success rate within the market. So again, it's the idea that if you have a coin and you flip the coin, there's obviously a 50-50 chance that it could be heads or tails. But people will think, okay, I've had four heads in a row. I'm much more likely to then get a tails on the next flip. It doesn't work like that. You need to always assess it in its own rights. And again, often you'll find expert advisors that do this. It will work on, they'll all be tested on past data, and past data is not always it's not a sign for future movement. So again, it's looking at everything and just trying to work out where you can improve. Again, some of this may seem simple, but you'd be surprised the amount of people that get stuck. So this leads me on to sort of lack of preparation. Again, seems obvious, but often new traders are keen to access the market, for want of not missing out. However, they'll have a far better chance of becoming a successful trader, if they educate themselves, take their time attending classes and webinars to focus their trading. You can also reach out to your account manager here, at PhillipCapital UK, and we'll be more than happy to help you with your development. Again, it's finding out where your interest lies, and also finding out from this what you know within that interest, and learning more. So F.O.M.O. trading. F.O.M.O. trading stands for fear of missing out, with traders much like the general public prone to bouts of envy. We want to attain the same success as other traders. However, this is not always possible, with many variable factors hampering this. Often we find traders do not realise they experience this even. However, there are some telltale signs, which include trading on all instruments, trading high frequency, and sudden sharp uptrend in trading volumes. Remember to utilise the tools at your disposal. Use MT4 indicators to support your strategy, to diversify your risk and increase volume, as you begin to increase your trading success rate and profitability. Remember, often it appears to be too good. If it appears to be too good to be true, it often is too good to be true. I mean, if you look at the indicators we looked at earlier, if you look at the RSI, again, does it look like it's being oversold? Is it being overbought? What's it done previously? Assess these things before entering the market. Again, you're not always going to miss out. There will be other opportunities. So yeah, just bear that in mind. Also, software. So software is obviously a fantastic tool to aid your Forex trading strategy, but please remember it is only that. It's not the answer to all your problems. We find that the most successful traders often use software tools, such as expert advisors, as an indicator to trade, as opposed to direct market execution. The market is always changing. Again, so monitor and review your software to ensure it's up to date and working in line with your trading strategy. So again, it's one of these things. Also, you find like a lot of social trading. It can be absolutely fantastic, to see who's doing the best and follow successful traders. But again, it can sort of make you very dependent on them, and perhaps almost create an information asymmetry in which they have the knowledge and you don't. Again, some people are happy to do that, but others will want to know a little bit more about what they're doing with their own capital. So again, just get to know the market and understand yourself and how you fit within that. Also, while we're on the subject of software, I'm pleased to break the news to you guys that we'll soon be able to offer you Zulu Trade. This is a social trading network in which you connect to the largest community of traders in the world. It's very, very good and very user friendly as well. So it's ideal for you guys out there that even if you're not perhaps ready to trade yet, you can look on there, look at the most successful traders, what's their success rate, what's their risk appetite. You can all personalize this within Zulu Trade and just have it suited perfectly to you. Again, as we've said, with software dependency, it's quite ironic that I've said it at this moment, but these are fantastic tools, but just remember to use them wisely. And also, if you do have any more questions regarding that, please feel free to ask me or one of my colleagues, and we will get back to you with more information. So we'll now move on to risk and money management. Risk and money management is the mathematical process of increasing and decreasing the number of contracts with the ultimate purpose of increasing profitability and protecting profits or capital during drawdowns. We'll learn more about this in the next few slides, so I will break this down a little bit, but this slide's just sort of fairly self-explanatory. So we all have to manage our money, whether this is in sort of general day-to-day life or FX trading. This begins with understanding losses. The table below illustrates the percentage changes needed to break even after a set percentage equity loss. This doesn't account for any financing charges. So in FX trading, you'll not have a 100% success rate. You have to accept that. It's again about having the majority of your trades. It's about having consistency. Losses do form part of your trading and have to be managed, as part of your overall goals. Also remember, stop losses are there for a reason and should not be amended without considerable thought. So again, if you can see in the text there, if you had share A, valued at £100 and it lost 50% down to £50, you would need a 100% increase in that price just to break even. And like I said, if the company then had financing charges, again within that you'd have to account for that as well. Quite often, again, seems very self-explanatory, but what happens is people perhaps lose a significant amount in a short period of time, and then become very positive and upbeat about the small gains that are then made after that. But perhaps what they forget is the fact that when they entered the market, it was at a lot higher price, and it's just remembering that you won't win on all your trades. But again, if you educate yourself and learn as much as you can, then like I said, you can become a successful trader and have more profitable trades than losses. So I won't run through an in-depth trading plan with you guys now. But like I said, please do reach out to us, supports at PhillipCapitalUK.com, if you want to discuss any of the below in more detail. What I will say is a trading strategy is fundamental to becoming an effective FX trader. Always consider your trading goals prior to entering the market, and test new trading strategies on a demo to determine the success rate before risking capital on a live account. So again, sort of a brief breakdown there, but I will cover you know, some of these aspects. But yeah, do always have a trading plan and goals. So the 2% strategy. This could be a strategy that you may wish to use, but if not, it gives you it still gives you an understanding of something that you could use in the future. So it introduces the concept of boundaries with a limit on each trade of 2% of your total account equity. The 2% level is not necessarily the correct level for you guys, but you know, the strategy does enable you to grasp a better understanding of the amount of capital that is at risk for each trade executed within the market. You'd be surprised by the number of clients who trade significantly higher total account percentages per trade. You know, but by that I mean you'll have one trade that accounts for 2% of your equity, and you have one trade that accounts for 25% of your equity. Again, you know, where's the consistency? You know, I'd also like to remind you that you should continuously review your strategy. You know, consider how diversifying into different financial products, you know, can help your, you know, overall help you achieve your overall goals. You know, again, understanding what you'll find how many people get loaded up within the same or similar financial products. So again, you could be selling sterling across a few different trades. If that's going against you, then it will go against you across your whole account. It's just thinking of these things. I know it seems self-explanatory, but again, these are traps that we find clients can fall within. Also, push yourself to earn the right to trade larger positions as your account equity grows. So naturally, if your account equity grows, 2% is going to be higher. If it goes down, 2% is going to be lower. But again, at 2%, you can afford to have a couple of losses. Trading a higher percentage, perhaps you can't. So again, it's without topping up, obviously, your balance. So again, these are just things to consider. Leverage. You know, leverage is a very much a top subject at the moment with the sort of new FCA regulations. It's also a double-edged sword. Quite often people seem to forget that. So you know, it can work with you, you know, when you're in the black, but against you when you're in the red. Always remember that risks along with rewards will increase with higher leverage. So at PhillipCapital UK, we are regulated by the, you know, in the UK by the Financial Conduct Authority. So the leverage we offer for FX majors is 1 to 30, and for FX minors is 1 to 20. This is shown in the table below. So again, you've also got the percentage, you know, margin as well. So again, it just gives you a bit of an idea of that. So this brings on to sort of fundamental analysis. Fundamental analysis is often referred to as trading the news, as it is the study of the news and economic statistics to determine trade opportunities. Fundamentalists, as they are referred to, pay close attention to changes in economic indicators. This will include, but it's not exclude, you know, not just this, but it will include economic growth, inflation, interest rates, and employment. You know, we saw this the other day with in Canada with Canadian inflation, so the CPI, and retail sales disappointed against their forecast. You know, resulting in an immediate slump for the Canadian dollar. So again, if you were looking out for these, if you had your economic calendar up and you knew the data was out, whether you knew it would be disappointing is another fact. But again, you know it's coming up, and you can do research and try to preempt where there'll be a swing. And naturally, if there is a shock to the data, there will be moves within the corresponding currencies. So, top-down versus bottom-up approach. The title's again quite self-explanatory. So within the top-down approach, The trader begins by analysing broad-based macroeconomic factors. This could include some of the factors we said previously, so you know, your economic growth, your inflation, you know, trade balance, those sort of things. Again, trade is very you know, important at the minute with sort of the issues and the trade spat between US and China. So again, you know, it's all stuff that's gonna affect markets. You then work your way down, narrowing and refining the research to target only those currency pairs that offer profit potential. You know, naturally, the inverse would be true for the bottom-up approach. Again, you know, you can look into this a bit more within your own time. If you do have any questions, then, like I said, do let me know. One issue with this: be aware that, you know, you can have confirmation bias, in which you'll interpret, favour, or recall the information to support a pre-existing belief or hypothesis. So, I mean, this can result in increased losses and missed opportunities. So again, it's the idea of the information is there, but you're reading it in a way that will support your own view, or a view that you've already hold. So it could be that you think sterling's going to go up, the pound's going to go up in value against the dollar. So I've gone in there with that opinion. So I'm now looking for data that reinforces that. It's not a good way to go about sort of trading and looking at data. Again, it's a fact-based thing, and it's you know, again, you can look at all the data, look at all the information that's available for you, look at has anyone given any indication, because quite often you will find government officials, prime ministers, presidents, central bank governors will give indication of perhaps how they're feeling and their future policy. So again, it's looking at these sort of things rather than having a previous bias in which can mislead you and result in increased losses. So yeah, I hinted on it a little bit a moment ago, but economic calendars, naturally, they should form part of your core trading tools. You know, even if you trade on technical analysis, you don't want to get caught out by unexpected sharp market movement, as you did not know about impending key market data. Again, it's the basics today. So like I said, a lot of you guys may already know that, but you know, it's good to sort of reinforce it. Also, try to understand correlated markets so that you can effectively hedge risk. This will help you avoid getting loaded up in closely correlated positions. You know, also, past correlation doesn't necessarily guarantee future correlation, but there are sort of, you know, currencies and commodities that will be closely linked. And if you understand this and know this, you can make sure that you don't have a portfolio that is loaded one way. Again, if this goes in your favour, fantastic, you're doing incredibly well. But if it doesn't, you know, it can you're soon going to be on margin call and potentially stop out. So it's a balancing act. So, fair value versus market value is the concept that there is a discrepancy between the price you see in the market, in other words, the price you pay, and the fair price, in other words, the true value. We've often seen this in equities and you know, with IPOs, so initial public offerings, when a share price is mispriced and the market rebalances on the fair price, you know, with the owner of the share realising the profit or loss, depending which way it falls. Traders will always look for mispriced financial instruments, as this will offer them a potential profit. So again, whether it's going short or long. If the fair price is higher, you know, the market price should rise, whereas if the fair price is lower, the market price should fall. Again, we've seen this with a few various sort of, you know, IPOs are quite good examples for that. I think we've had Aston Martin and sort of Royal Mail and a few others. Again, it can be quite difficult to price new shares, and you know, often you then end up with have to sort of second guess the value of the company within the market, the branding, and again, the public and owners then almost decide, and the markets decide where that falls, and sometimes it's not perfectly matched, which is going to happen. So, key macro data. We've mentioned a few of these earlier, so I won't laboriously go through each one, but they are listed. So that you can gain a greater understanding of the major macro data that has the potential to swing markets. So again, I'm not going to go through all of those, but take a look at them either now or in your own time, and look into it. What have we got coming out this week or next week that could move the markets? Again, this is the stuff you need to look out for, because this will affect your trading. So this moves me on to technical analysis. Technical analysis is vast and in-depth. So there's numerous tools and analysis of which to look into. For today's webinar, I'll take a look at Japanese candlesticks, as they are a very popular trading tool used by technical traders worldwide. Japanese candlesticks, as the name suggests, originated in Japan in the 18th century. This is when traders developed their own technical analysis to trade rice. It was not actually until the 1990s when it was introduced to the Western world by someone called Steve Neeson. He's the author of Japanese Candlesticks Charting Techniques, a contemporary guide to ancient investment techniques of the Far East. Again, if you have an interest in this, then perhaps you can have a look out for an old copy of the book, or look into Neeson himself. So again, he was sort of a pioneer in this field, because he brought it into sort of the 20th and 21st century. So again, it's used today. People, there's a lot of studies on this. So each candlestick is designed to be easy to view. So what you want to see the information as quick as you can. So I can enter the market and find opportunities. Again, I don't want to be looking everywhere to find the information. So within the candlestick itself, you'll clearly see the open, the high, the low, and the close price. It's a visual aid. They're visual aids, and they're used to describe the price action during a given time period. The time frame is customizable within your MT4 trading platform via the top toolbar. Again, if you're not sure how to do this, or you want me to go through this with you, happy to help you sort of within your own time. But do get in contact with us. So yeah, you'll use the candlesticks to monitor trend patterns. Assessing an instrument. Its opening, close, its highs and lows, and this will help you to make an informed decision within the foreign exchange, commodity, or index CFD market. You'll also look at the intensity of trading, assessing the buying and selling pressure within the market. You could use this alongside the RSI, and again, how many people are buying, how many people are selling, trying to work out where the market is moving. And if you know where the market's moving, you do have the opportunity to be profitable. So yeah, in this section, I'll quickly run through the anatomy of candlesticks. So you can identify the key features. We did hint on them a moment ago. It's essential. That the information is there. You want this information. It enables you to make time-effective decisions. In correlation to your trading strategy. And trading time is incredibly important within trading. You don't want to miss opportunities. I mean, like we did say earlier as well, I mean, sometimes it's better to miss opportunities, but again, if you see an opportunity and you've done the research and you know it's there, then why not enter the market? Japanese candlesticks show you the open, high, low, and close for a set period. You can see that on the table below. So we've got the bullish candlestick and the bearish candlestick there for you to see. The bit in the middle is called the real body. Again, you can see that there in front of you. They do both have, the bodies themselves do both have long and short bodies. The ones below are exactly the same, but you'll find a lot shorter ones and a lot longer ones. Naturally, the longer the body, the bigger the difference between the open and the close. As a general rule, the longer the body, the heightened buying or selling pressure in the instrument during the period of time. Naturally, the inverse is true, so there's less price movement obviously in a shorter body candle, with price consolidation taking place. A long black candle shows a strong buying pressure, whilst a longer white hollow candlestick shows selling power. Again, they're there for you guys to see, and like I said, they're labelled as well, so you can see the increasing and decreasing candlesticks there. So we're now going to have a look at the candlestick patterns. So the three line strike. This can be both bullish and bearish. Again, you saw the bullish and bearish trends on the last slide. I'm going to explain the bearish model, but naturally the bullish model will be the inverse of below. So the bearish three line strike consists of 4 candles, 3 of which are declining and record a lower close price, whilst the 4th will initially open lower again before reversing in a wide range outside bar to end higher, than the first candle in the series. Again, you can see that in the graph, the graph on your screen in front of you. So, Thomas Bukowski, who is a leading author in the field, along with Neeson, he would attribute an 84% accuracy to this chart pattern. So again, you can look into MC4, look for this pattern, and test it out. See if it, again, 84%. I mean, presumably he like I said, he will have looked at previous data to come up with that percentage. But look it out for yourself. See how does it work for you when you're trading. Again, it's just applying this to you guys at home. So now that we understand the three line strike pattern, we'll look at applying this to a real life scenario. In this case, cable. Assessing the various considerations that all traders must take. Firstly, candlestick patterns are a technical indicator forecasting probability, and they offer no guarantee of success. Nothing can or should be taken for granted when trading within Forex markets. I mean, that goes without saying. And Japanese candlesticks should be used in conjunction with other technical tools. Whilst fundamental factors should also be taken into consideration, as key market data will move markets, increasing both volume traded and volatility. Remember also to continue to review your trading strategy. I know I've said this previously, but it is important. Look at ways you can improve, and try not to move your stop losses. You did put them there for a reason. Quite often it means you just run a bigger loss for a longer period of time. So let me just go on to the next slide. So this final slide here combines the three line strike candlestick pattern with support and resistance levels. The graph below shows the formation of a bearish three line strike, which we covered earlier in this webinar. Whilst, as you can see, I've added the minor resistance and minor support levels. With the example below, by utilising your knowledge on support and resistance and candlestick patterns, you could choose to enter the market long at 1 spot 28719, the minor support level, prior to the bullish momentum taking place. If you then take a stop loss close to the minor resistance level at 1 spot 28843, you would have gained 12.4 pips. Again, this is just an example, and past performance is not indicative of future performance. So again, this does not mean this will happen in the future, but like I said, it just gives you an idea of how you can apply candlestick patterns alongside other technical analysis, whether this be support and resistance, whether this be some of the indicators that you're using, the RSI or moving trend lines, as well as economic data. So again, like I said, it's about combining all of these things together and having sort of one big picture in which in that picture you fit, and you understand your trading strategy and what you want to achieve. So sadly, that brings an end to the webinar today. So I just wanted to say thank you all for joining us, and I hope you enjoyed the webinar on Forex Trading the Basics. I hope you found it both interesting and useful. If you do have any questions, please do get in touch with our support team. at support@PhillipCapitalUK.com or on 0207 3983 100. Thanks again for your time. Goodbye.